Welcome back. And IT is, of course, the flavor of the week. And we have Sandip Agarwal, fund manager, Sowilo Investment Managers, joining us this morning to try and get a perspective on how HCL Tech and TCS's numbers were. Sandeep, was good chatting with you yesterday, but renewed vigor today. We've got commentary as well coming in, so I'm trying to get a sense as to how you're reading through the numbers. First, let's take TCS. In terms of the margin number, slight positive bias that we saw. Even the top line came slightly ahead in terms of constant currency as well. Are you seeing positive cues both in terms of the way management is looking at the business as well as the way in which growth seems to be shaping up?
Hi, good morning, and thanks for having me on the show. So
Good
the
morning.
way what is happening, if you see the large cap numbers, we have two numbers right now already, and more will be coming, and we have street estimates also to see through. So what we are gauging from the current situation is that the numbers are slightly both for TCS and HCL were slightly better than what was anticipated, and even on margins they have been able to manage the cost well. But if I think the key number to look at is two numbers. One is the book to bill. In case of both the companies, the book to bill has been reasonably okay. I wouldn't say that it shows any green shoot of a big upside uptick in demand. Secondly, we also need to see the year-over-year growth in constant currency, and I think that year-over-year growth numbers remains very subdued, below 5% for all the large companies in this quarter, and even same thing probably will be there next quarter also. So given this situation, we need to think of how investors think. Right now the rupee depreciation is a very big support, because while the year-over-year growth number in dollar and constant currency looks below 5%, but in terms of rupee they have shown a good uptick. And it is more of a currency gain which has flowed down. But finally, for investors, it is the INR which also matters. So I think from a fundamental revenue growth perspective, there is not much to read positive. But at the same time, on the margins and way rupee has depreciated, it has resulted into better numbers, and it will probably continue to be better on the bottom line for some more time. It is up to the investors what kind of peg ratios they want to give. We go purely by peg ratio, and peg ratio basis, I think the whole sector is still very expensive and not attractive in our opinion.
Okay. Sandeep, this commentary by TCS, this aspiration of getting to 26 to 28% margins, you believe it's realistic? Because what we are seeing is TCS trimming down their number of employees by 11,000 this quarter, uh, roughly, give or take a few. But they've also trimmed it by nearly 30,000, I believe, from the start of the financial year. So the trend seems to be that they're trimming on employee count, and therefore will margins go up?
No, so I would say that it is a very reasonable manpower cut which they have done. Ideally, if you see the impact of AI on effort reduction, it is broadly 25 to 30%, and all these companies have done 3 to 4% kind of employee cut only, or maybe 5% cumulatively, which is a very reasonable number in my opinion. And this is the right thing, because if you don't do that, then your margins will take a big hit, and also it will result into inefficiencies and other challenges. So I think it is the best thing, and that's the reason I love all the Indian IT company management. They are very pragmatic, they are very calculated and measured in their approach, and this is really a good step. I think right sizing of the workforce is the need of the hour. Otherwise, it will throw up a lot of challenges later. So what AI has done is substantial reduction in effort, and you have to comply with that change in the dynamics.
Hmm. Sandeep, the other piece that's played out, at least on TCS's numbers, is that one-time knock that they've taken with regard to the new labor codes. Non-cash expense, right? So cash remains. It's just a liability that gets blocked. Trying to understand how should one look at this number, because it's a large number, and it's the reason why maybe profit as an absolute number hasn't been able to live up to analyst expectations.
No, so you have to see this labor code impact in two parts. One is the one-time part, and another is the recurring part. So I think the one-time part will be substantial, and the recurring part will be much lesser, because see what biggest impact which will come in is the repricing of the future liabilities. So primarily gratuity, leave encashment, and all that, which are because that is linked to the last drawn basic salary, and the basic salary, if it gets changed in the whole composition gets changed, then there will be some liability which will come. I think this labor code will have maximum impact on the organized part of the industry, which is IT and banking to the maximum extent. Rest of the industry, we don't see much impact. We have done some numbers. But for these two industries, there is a challenge. But I think, we have to take this as a cost. And the recurring cost is very, very low. I don't think, it warrants any kind of cut in estimates or something like that. It is a very, very short-term impact. One-time impact is big, which cannot be considered as a recurring impact anyway, and the recurring part is very, very small. So I don't see this as a material thing to consider.
Sandeep, what really stands out is HCL Tech's numbers. Across the board, it's a beat. The 18.6% margin, and we spoke about this yesterday as well, was extremely strong. And they've hiked their guidance as well. Is that something that really stood out for you? The confidence that HCL Tech demonstrated in terms of it turning out to be a bit of a turnaround of sorts that's playing out, or was it largely anticipated?
No, I think the numbers were definitely much better than estimate, and there is a positive surprise from products and platform side, and that business is a seasonal business. This quarter is one of the strongest, and we have seen in the past that sometimes, rarely it has disappointed also, and most of the times it has surprised in a big way. So I think this is one quarter thing. Every year, 1 or 2 quarter, this business gives positive surprises most of the time, but we have to also see the other part of the business, which is the services business. I think there is quite inline numbers there. So I would again say the same thing, that if you see the full year guidance, it is below 5%. So we have to just see where this industry is moving. The challenge is, there are two key challenges in the industry. One, the market in which they serve is very, very matured. We have like the lion's share of the outsourcing piece developed markets. And second, all the small companies which did not have the balance sheet or the constraints where they had to participate in the large deals. Only Infosys, TCS were able to participate. Later on, HCL Tech. Now I think post COVID, what has happened due to small sizing of the deals and the quicker execution period, those constraints of minimum balance sheet size and minimum execution in the past, all those have been taken off, and because of that, there is a very tough competition in every deal. From 2-3 vendors, the vendors have gone up to 10-12 in every single deal, and that is the challenge, and that is what is reflecting in the high growth of mid cap and small cap companies in the last 4-5 years. The only thing is that while there is a growth differential, but the pay ratios are even more expensive. So we are not constructive in the whole sector. We believe that other than INR depreciation, there is no fundamental reason to be in the sector in the near term. Probably, when the pay ratios correct meaningfully, we will have a relook.
Interesting. So Sandip, wondering what's the anticipation from Infosys next?
No, so again, I think we have to remember that there is a huge exposure of manufacturing which undergoes furlough in this quarter. So broadly, it will be again a low growth quarter on a year-over-year basis and quarter-on-quarter basis both. But again, those are all there in the expectation. So we don't expect a big positive or negative surprise. The way expectations are, most probably, most of the companies this quarter will surprise positively because the expectations have been toned down very, very sharply. And I think in this kind of environment where there is so much of noise on tariffs and so many other things, even the growth which these IT companies are able to post and the way they are able to manage all this noise around the visas and all, I think it is an incredible job by the managements of the company. They are doing superb work, and I think long term these companies will again do well. In near term, there is a multiple challenges. The visa issues are there, the tariff issues are there, and also there is uncertainty, and add to that the expensive nature of the stock. So I think all this taken together, and AI disruption, the stocks will languish here under time correction or something, but maybe 12 to 18 months time frame, this will again become a very, very attractive sector for the investors.
Okay. Sandip, we leave it at that. Thank you so much for coming in and speaking with us. Of course,